Good morning, and I'd like to thank you for joining us for our third Thursday marketing meeting here for the month of December as we're closing out the end of the year. We still have a few people joining, so we're going to give it a minute or two here and let everyone get signed up and also see if we can find Brooks. He seems to be out wandering around somewhere this morning. So bear with us just one moment and then we'll get going. So it's been a very interesting year. We've seen commodity prices decline noticeably. We've seen a lot of volatility in the stock and bond markets and some things we might want to be looking at for next year. I'll go over those in a little bit. But first, let's take a look at where the markets are currently. So I'm going to go ahead and put some charts up here. Oh, and before we do that, though, it is the official AgriSompo Ugly Sweater Contest. I appear to be the only one who got the memo. So in light of that, I'm going to take this off so I don't roast here in front of everybody. So moving on. And so everyone can see this, we're going to go ahead and we're going to start. We're going to first start talking about the corn market. As we've seen, corn did enjoy some summertime volatility, and we did see prices drop noticeably, and we are currently trading on the March contract at about 472. We aren't going to see a lot of bullish factors, I think, to drive the corn market going forward. We did get a little bit of some help from the soybeans earlier on South American weather concerns, and that did create a little bit of volatility. Those weather concerns are beginning to abate, though. We're also seeing pretty good weather in Argentina, so those two are going to balance out. So we are probably looking at some fairly hefty South American crops coming. Yes, this could change, and we could see some change in the weather. That's something that could potentially help prices. On the other hand, the situation in the U.S., we are experiencing a serious drought. It's going to be 55 degrees tomorrow in Omaha, which is a little bit unusual. We've had exactly 2 precipitation events. That means it rained twice in the last 3 months. And we are in a deep drought, and this is beginning to spread over into Iowa and points further east in southern Illinois down by Brooks and stretching out into Indiana. If this does not change, we could have a problem for farmers. Obviously, that creates some issues for crop production, but that could be something that could be beneficial to prices. Moving on to the soybeans. The soybeans are struggling, but their struggle is not nearly as mighty. When you look at planting costs of putting in soybeans versus planting corn and where the price for soybeans are actually holding up pretty well. We have a naturally and inherently much tighter supply of soybeans globally. Demand continues to rise also for soybeans, from everything from biodiesel to other assorted feed products. And that has kept the soybeans a little bit more stout. Right now, here looking at the March contract, we have major support right around $13. And the same is true for the January. And as long as we hold this support and don't dip down too much below it, we will probably see some bargain hunting come in, and that will be supportive towards the January soybeans. Moving on to, let's take a look at the wheat market here. The wheat market has been struggling. It's never a good sign when a chart starts at the upper left and finishes down here in the lower right. We did have some improvements here, and if you read tonight's export sales report, you will see what's going on. Is China did come in and purchase a lot of wheat. How much wheat? We had the best weekly export sales over the last couple of weeks that we've seen in the last 18 years. So they have bought the wheat now. One thing I'd like to point out is it's China. Just because they buy the wheat does not necessarily mean that they're going to take the wheat. And if these sales do in fact happen, that's something that will be supportive to this market and can kind of at least get us off the floor here. But we're going to need to see some sort of supply or production disruption in order to get any sort of really bullish foundation to move the market. Again, with the weather situation, while we're seeing drought here in Nebraska, points south, let's call it the middle of Kansas going south, have seen some beneficial rains, and this is something that has improved the situation for prospectively for cotton next year, and certainly for winter wheat that's planted. So this is something that, while it's good and we want to see precipitation, it's something we have a heavy wheat supply. The market is not all that bouncy. Seeing some better production numbers is something that could certainly come in here and weigh on this market. Moving on to the cotton market. Okay, cotton has struggled and struggled mightily. We've seen prices bounce up, and then we just kind of fell apart here after seeing this good rally. Cotton is clinging to support right now. As you can see, I'm going to draw a little line for us here and show this here support. As you can see, we're holding prices, but we're not exactly moving higher in a raging sort of bullish manner, but we're not really falling apart near term either. And we draw a line like this, and we suddenly have a bit of a triangle pattern forming. And how we break out of this triangle will generally be indicative of what the next move is. With this triangle pointing lower, that tends to be kind of a bearish item where the market continues to lose strength. So unless we see something here to drive the cotton market higher, which number one would be an increase in export sales. We had a period right in here where we got this good bounce and we quit going down with some very good export sales to China. Those have abated. Again, export sales came out this week and they were not, again, anything to write home about. If you look at the RSI, the situation is very neutral with this, and this is something that is not going to affect the market really going one way or the other. But if we do start to break down through this, we could see potential prices moving noticeably lower back into the lower 70s for the time being. Cotton demand on a retail level remains very, very soft, even though consumer demand and retail sales have been very good the last couple of months. Fashion is out of fashion, and until we start to see teenage Americans really change their behavior, cotton is going to be a difficult item, and the prices are going to be heavy. Talk about something a little bit different here. Normally, we always talk about the grains and we talk about things in depth. I'm going to talk about cattle a little bit here because the cattle market was one of the best performing markets that we've seen in the commodity space this year. And again, we saw a situation where things were good until they weren't. We noticed we had beef prices, cattle prices pushing $195 a pound. And we have, $1.95 a pound, $195 a pound. Well, the inflation could really take over that. Well, we've come back down to $1.60 a pound. And part of this is what's happening on the retail end. We have box prices, which are what the retailer actually pays for the beef. Those have not been able to get any sort of footing. They have not been able to find any sort of bullishness, anything. The consumer is behaving as if it's tapped out. This compressed packer margins, meaning they were actually losing money on every animal they process. And this has driven the futures prices lower. We still have fundamentally tight cattle supplies. So going forward, we're going to have fewer animals, in a situation where the processor and at the end of the day, the rancher does not really have pricing power in order to drive prices up. So we may see a situation where we could see, if you have an animal that's not penciling, either the entire feeding complex is going to have to go much lower, or we're probably going to start to see lighter animals come in again, which will only further tighten supply and will exacerbate this problem further down the road. And eventually, beef prices will be higher and beef prices will be at the margin a little bit more scarce. I'm not saying we're going to run out and you're not going to be able to find hamburger, but at the margin, prices will end up having to go back up, which could lead to a resurgence of inflation. On the other hand, we have the hog market. And we're seeing an interesting disparity in the hog market. This is where hog futures are right now. Right now, they're at the equivalent of 71 cents a pound. And here, too, we have seen prices move noticeably lower. And this has been, again, we are seeing increasing hog supplies. And now, when we look at cash prices for hogs, though, I'm going to bring those up here very quickly. If we look at cash prices for hogs, we've seen cash hogs are now at 47 cents a pound. So we have a pretty good disparity between where the futures are and where the cash is. Packer margins are very, very good right now for the processors with hogs. They're making almost record levels of amounts of money. So this is making up for what they're losing in the cattle. So Tyson stock doesn't completely fall out of bed. If we continue to see these hog prices go lower, and there are some seasonal factors that tend to drive it lower this time of the year, we could see the hog futures move meaningfully lower. We have, again, the consumer is not really performing very well. While we see good consumer and retail sales, those aren't always necessarily adjusted for inflation. What I like to look at is pricing power in the supermarket, and do the processors and the makers of food actually have pricing power? If they don't, that's a pretty good sign that the consumer is tapped out. So seeing this big disparity with cash hogs and where the futures are, this could add to some bearishness. There's a pretty good sized fund position that is weighing on things, and this is something that is going to, could create some fuel for a rally, but right now there's really not anything here to drive these prices up. And let's talk about everybody's favorite item to complain about. Let's talk about gasoline and energy prices here. And if anyone has any questions, certainly feel free to put them into the chat or let Ashley know, and I'll be happy to answer them. As we see here, crude oil, we've had this wonderful drop in prices where we've come down from 87 all the way down to $67 a barrel. And all of a sudden, things have now begun to change a little bit. We're beginning to see prices move higher. Now, we did get some fairly bearish news this morning. Angola, which was a major oil producer, yes, a lot of oil actually does come from Africa, announced that it is leaving OPEC, and that is weighing on prices a little bit. I also have some trivia for you. What country in the world produced the most oil in a single month ever? Was it Saudi Arabia? Was it Russia? Was it Iran? Was it Iraq? No, it was actually the United States in the month of November. Yes, we produced the most oil of any country ever in the month of November, and that is one item that has worked on driving prices down. Now, one thing about this oil, a lot of this is fracked oil. This oil is not that cheap to pull out of the ground. It's simply, if you start to get much below $65 a barrel, all of a sudden you're not making money pulling the stuff out of the ground. So that kind of creates a natural floor for prices. Along with this, OPEC, Mexico, other assorted oil producers in the world, a lot of their oil is a little bit cheaper to produce. They are quite willing, to set on production and move prices higher. So I'm not saying that we can't go lower. I don't think we can go much below this. And given all the geopolitical situation going on, it is entirely conceivable that we could easily, readily get oil back up. Let's call a range 75 to 85 is a reasonable fair value. It doesn't affect demand that much. The oil companies are making enough to be satisfied, as are the exporters. So seeing that market move back into that level of equilibrium would not be too surprising. If we move much north of about 85, moving towards 90, that becomes an inflationary problem. And that could ignite some other problems. So what does that mean in real terms for folks at the pump? What that means is, we're going to bring this up, talk about gasoline prices here real quick. Gasoline prices, as you can see, we moved the wholesale level, we moved down from a peak at around $2.53 a gallon. We came down and we tested the $2 gallon, and we had this very nice technical buying signal right here mixed with a fairly good RSI reading, and prices have bounced. Bottom line is, processors, refiners don't really make enough money to keep Wall Street happy at $2 again. That's just the math of the situation. Seeing us take the futures price back up, back to the 230 level would be fairly neutral and a little bit inflationary and a little bit annoying, but that's about the area where we can keep and maintain production levels and where the prices need to be. So looking at that, we did enjoy this nice little bit. I actually bought gas for sub $3 a gallon. Enjoy it while it lasts, because most likely we're going to see prices have to move back up from these noticeably depressed levels. So that is the good news and a bit of the bad news. It appears that Brooks is not going to be joining us, so we're going to talk about a couple of other things and wrap up here very quickly. We've talked about energy prices, livestock prices, and let's talk about interest rates. Now, there's an old joke. There's a prison across the street from the Board of Trade in Chicago. And anyway, Albert Einstein somehow found his way inside this prison. And inside this prison, there were also a bunch of traders. And Albert asked the first prisoner, "What's your IQ?" Oh, the prisoner says, says his IQ is 160. He says, "Well, that's great. We can talk about the price of soybeans, because that's the most complicated thing to trade." The next prisoner he meets has an IQ of 140. Says, "Well, we can talk about corn. That's a little bit more difficult to trade, but that's something on your level." The next guy he meets has an IQ of 120. Says, "Well, we can talk about gold in the stock market, because those aren't, anything." The last guy he meets has an IQ of 60. He says, "What are we going to talk about?" And Albert turns to him and says, "We can talk about where interest rates are going," because nobody really knows. And this market has clearly proven this. As we saw, interest rates moved up on the 10-year note sharply to north of 5%. We have caved all the way back to, let's put a little line in here. We have come all the way back to where we were in July, now trading sub 4%. The yield curve remains deeply inverted, meaning that if you want to lend the government money for 6 months, they're going to pay you 5.25%. But if you want to lend them money for 10 years, they're going to pay you 3.87%. That is not normal. It should be the other way around. And if short-term rates are at 5.25, we should see the 10-year probably closer to 6. This is often a signal of recession coming. And I could get into a whole lot of very difficult and messy things, but we don't need to do that on a Thursday before a holiday. But anyway, we should expect more volatility here, and this rate move has been quite curious and pretty much unexpected by all participants. So again, pay attention, because things will change. That's the one guarantee I can make. So the other item here is the stock market. As you can see, we came down. We have had this blistering rally, which doesn't look so bad on this chart, but here, if we give it a little bit of time, we can see just how parabolic we've moved up. And we are heavily overbought. We had our first little dose of volatility yesterday, which for those of you who like to read charts, I'm going to point out a little similarity. You see this pattern from yesterday. As you can see, it's an outside day. We traded outside the previous day's range. We had a lower close. That often indicates a change in trend. If we go back right here, the 27th of July, you see the same thing, consolidated but didn't violate to the upside, which would negate the signal. As soon as we violated to the downside, started a pretty good correction. So this is a bit of a warning sign, particularly when you combine with this very much overdone RSI. So be careful out there. I'd like to remind everyone to make sure to listen to the podcasts. I'd like to remind everyone to make sure to read the daily commentary because we are dealing with a situation that's deeply in flux. If you ever have any questions, certainly feel free to reach out. I am happy to answer any questions that you have. And if I don't know the answer, I'll tell you I don't know the answer. And if I can't find the answer, well, that's kind of how it rolls. Certainly reach out to Brooks and I. We're happy to help you with anything you have going on. And most importantly, have a happy and safe holiday season. And with that, I will see everyone back in January for the January WASD, which is an important report. Things will definitely be changing with that January WASD, and we're going to want to be fully tuned in for that. So again, if you have any questions, feel free to reach out. I will be off the desk tomorrow and Wednesday, so there will be no DMOs or podcasts. Thanks, and have a great season.
Merry Christmas, Sterling.
Merry Christmas.
We'll see you in January.
See you in January.